Welcome back. Today we are undertaking a deep dive into the Q3 2025 earnings call for IBM. This was a pretty critical report dropped after hours on October 22nd.
Indeed.
Our mission really is to cut through the noise here, understand the complexity of these results, the major beats, the raised guidance, and try to square all that positivity with the, surprisingly sharp negative reaction we saw from the market right after.
Yeah, it's a fascinating one. We are looking at a story defined entirely by contrasting signals.
Yeah.
On one side, you've got management delivering, frankly, exceptional financial execution,
Right.
and signaling strong confidence for the full year, particularly fueled by a successful hardware cycle. But then the other side is the street's immediate reaction, which just fixated on one specific area, a deceleration.
Yeah.
Leading to that volatility.
So for anyone following IBM, this quarter needs a very careful look.
Definitely nuance.
Okay, let's unpack the headline numbers first, because if you just looked at the raw data, it seemed unambiguously strong. Starting with profitability. Operating EPS, or non-GAAP, as they call it, came in at $2.65. Now, that blew past the consensus estimate of around $2.45 by a solid 20 cents. That's a pretty big beat on the bottom line.
A very comfortable margin, yeah. And critically, this wasn't just, cost-cutting driving it. They grew revenue, too. Total revenue landed at $16.33 billion.
So ahead of consensus.
Right, ahead of the roughly $16.09 billion forecast.
Yeah.
That translates to a robust 9% year-over-year growth, or 7% if you adjust for constant currency, which shows real underlying business momentum, regardless of FX swings.
And the management team clearly felt that momentum. That led them to raise their full-year guidance, always a key indicator of confidence.
Absolutely.
Constant currency revenue growth is now projected to be greater than 5%. That's an upgrade from their previous at least 5% language. But the number that really matters for long-term investors is free cash flow, FCF.
The big one.
They now expect that to be about $14 billion. That's a significant commitment, a huge number.
It is a strong commitment. But here's where we hit that fascinating divergence we mentioned right at the top. Despite beating on both revenue and earnings, and despite raising that crucial FCF outlook,
stock went down.
Shares fell, approximately 5 to 6% in after-hours trading. It felt like the market just completely discounted the good news and zoomed in on one specific data point, that moderating growth rate within the Red Hat and hybrid cloud segment.
That's the friction point we absolutely have to drill into. How does a stock drop on a strong beat and a raise? Let's get into the segment performance and see where that internal conflict really lies, because the results were, intensely mixed under the surface.
Okay.
Infrastructure, which houses the mainframe business, was the undisputed star of the quarter. That segment surged 17% year over year. Huge number.
And that surge wasn't spread thin. It was driven almost entirely by the current cycle of the IBM Z platform, the Z17 mainframe.
Right, the new cycle.
That specific revenue stream delivered an absolutely massive 61% year-over-year increase. Now, this is cyclical, obviously, but management was very clear. They're tying this mainframe cycle explicitly to the accelerating demand for AI workloads.
Okay.
These workloads require massive real-time processing and, crucially, the highest levels of quantum-safe security, which, regulated industries absolutely demand.
It's kind of hard to visualize 61% growth in something seen as traditional, like a mainframe. But management did try to put the capability in context. They said a fully populated single Z17 system can handle 450 billion inferences per day.
Incredible scale.
To put that scale into perspective for you listening, that's like processing every single major U.S. financial transaction multiple times over every single hour. This isn't just keeping the lights on anymore. This is modern, high-speed, secure AI infrastructure for banks, healthcare, telcos.
Exactly. And that success suggests the Z system is really serving as that defensive anchor for these highly regulated clients who are moving their AI pilots into, scale production now.
Okay, so that naturally leads us to the software side then, because that's where the friction, the market concern began.
Right.
We saw the Z system hardware surge because of AI workloads. So how did the actual AI software layer perform, including that crucial Red Hat component?
Well, overall software revenue grew 10% year over year, which is, pretty solid on its own. And automation was a real standout within that, growing 24%. That was boosted by synergies from earlier acquisitions like HashiCorp.
But
the concern, as the market clearly signaled, lies squarely with Red Hat. Its growth moderated down to 12% constant currency.
Okay, and what was management's explanation for that slowdown?
Their explanation was that it was largely due to tough comparisons, lapping last year's exceptional performance, what they call wrapping on those high growth rates, and also some temporary softening in consumption-based services, which frankly is a broader cloud trend we're seeing right now.
That explanation does require some critical thinking, though. If the whole industry is moving towards AI deployment and the mainframe is flying because of AI demand, why is the cloud-native infrastructure layer, Red Hat, showing softness? Is this really just a temporary cyclical thing, or maybe a sign that the AI revenue isn't flowing into Red Hat as quickly as people hoped?
Management insists it's transient. They projected a pretty clear acceleration for Red Hat heading into 2026. They pointed to strong bookings in this quarter. Q3 bookings grew 20% as the leading indicator that revenue growth is simply delayed, not derailed. They sound confident Red Hat gets back to mid-teens growth.
We'll have to see. Okay, let's shift gears slightly to the long-term thesis, which for IBM really relies on profitability and cash generation. Despite that internal conflict in the segments, the overall profitability picture looks incredibly healthy, right?
It does, yeah. And this is where the operational discipline really shines through. IBM showed significant operating leverage in Q3. They drove 120 basis points, that's 1.2 percentage points of expansion in their operating gross margin, hit 58.7%.
And that's not a one-off.
No, not a fluke. They've now delivered 9 consecutive quarters of operating pre-tax margin expansion. That shows real resilience in the model.
And that operational tightening is obviously translating directly into cash flow.
Exactly. FCF generation is robust, $7.2 billion just year to date. And that resulted in the highest 9-month FCF margin in the company's reported history.
Wow.
Yeah, the cash story is strong, and it's reinforced by their internal productivity metrics. Management highlighted that their internal productivity gains driven by implementing their own AI and streamlining business processes are way ahead of schedule.
How far ahead?
They're now expecting $4.5 billion in annual run rate savings exiting this year. That's nearly double their initial $2 billion goal. That kind of operational tightening provides a huge cushion for that raised FCF guidance.
That sounds fantastic on paper, but given that massive FCF generation, why aren't they perhaps seeing better immediate returns to shareholders? Or maybe are they holding on to this cash for a big transformative acquisition? Or just building a fortress balance sheet?
Well, they're definitely maintaining discipline while building that fortress. They reinforced their M&A strategy pretty clearly on the call. They stressed any deal has to meet 3 specific criteria.
Okay, what are they?
1, it must fit the hybrid cloud and AI strategy. 2, it must create synergy that leads to accelerated growth after the acquisition. And 3, it has to be accretive to cash by year 2.
So that framework suggests they're not really interested in huge, potentially dilutive deals.
Exactly. It points towards targeted bolt-ons that boost the Red Hat ecosystem. Much like they cited the successful HashiCorp synergy, which, as we mentioned, helped drive that 24% growth in the automation segment, they want things that fit and accelerate, not just get bigger.
Got it. Now let's pivot from the numbers themselves back to the strategic vision. How is this AI story actually translating into revenue today, beyond that big Z system hardware surge?
Well, the overall AI book of business, as they call it, is now massive. Management stated it exceeds $9.5 billion since inception, and they added about $2 billion just this quarter alone.
That's significant growth.
It really shows enterprises are moving past R&D and experimentation into actual scaled deployment of AI.
And what specific capabilities did they highlight on the call?
The focus is really on the watsonx stack for integrating generative AI. They also heavily promoted the partnership they announced in October with Anthropic.
Claude, right?
Yes, infusing the Claude AI model directly into IBM products. This allows clients to deploy these high-performing foundation models wherever they need them, including, crucially, securely right on that Z17 mainframe environment we talked about.
So it ties the software and the hardware together.
Explicitly, yeah, with a focus on enterprise governance and regulated deployment. And as a result of all this activity, their consulting business saw a positive inflection point. It returned to growth, 3% year over year, driven almost entirely by AI implementation services.
Okay, so we keep coming back to this central contradiction, this key question. The company seems to be hitting on all cylinders, record XCF pace, record Z system cycle, raised guidance, massive AI book of business.
Right.
Yet the stock drops 5–6% after hours. Why did the market seem to ignore all the beats, the raised FCF, the infrastructure surge, only to focus so relentlessly on that Red Hat moderation?
I think it really comes down to perception and momentum. Heading into this earnings call, IBM stock had had a very strong run year to date, up about 30%.
Okay, so expectations were high.
Exactly.
Yeah.
The market view seemed to be that the software segment, and particularly Red Hat within it, needed to sustain its high growth rate to justify further multiple expansion and the premium valuation it was starting to command.
So the moment that growth decelerated.
The minute it decelerated, even with management explaining it as temporary and cyclical, investors viewed it as an overhang, something that limits the near-term upside potential. It's almost a psychological divergence where the market prioritized that software growth momentum over the perhaps more fundamental cash generation and hardware strength.
So basically management is saying, look, trust our bookings, trust our strong FCF flow. Red Hat will reaccelerate in 2026. But the market's response is more like, show me the acceleration now, or we're going to treat this as a deceleration risk.
That sums it up pretty well, I think. Precisely. Yeah. Management did provide context that should logically reassure longer-term investors.
Yeah.
Like Red Hat bookings growing 20% in Q3, that is a strong leading indicator.
Right.
They also predicted that transaction processing, or TP monetization, which is tied directly to that Z17 cycle, will return to growth in Q4. That adds another layer of near-term revenue certainty that maybe got overlooked in the initial after-hours reaction.
Okay, all right. Let's pivot then to our mandatory non-financial advice segment. Given this profound divergence we've been discussing, the stellar defensive Z system performance versus this sort of cyclical Red Hat anxiety, how do we even approach this kind of idiosyncratic volatility?
Well, if we try to connect this specific IBM story to the broader market context, the potential trade here is essentially betting on the mainframe being that entrenched defensive AI anchor for regulated clients and viewing their Red Hat noise as, well, a temporary market inefficiency.
So betting on value over momentum, essentially.
Pretty much, yeah. Betting that the fundamentals went out.
Okay, so give us the outrageous but plausible trade idea that specifically capitalizes on this internal conflict we've dissected.
Okay, here it goes. It's a relative value spread trade targeting this specific sector disparity. You would potentially go long IBM, or maybe long a defensive call spread on IBM.
Okay.
Funded by shorting the nearest competitor whose main revenue stream is primarily consumption-based cloud services, particularly ones showing broader deceleration signs in their core cloud infrastructure business.
Okay, why that specific structure? Why pair IBM long with a consumption cloud short?
Because IBM, particularly with this Z17 cycle, is selling defensive infrastructure for regulated industries. It's generating massive, predictable free cash flows, remember, $14 billion expected for the full year. That 61% growth in the Z system looks like a structural, high-security-driven cycle.
Right.
By contrast, many competing cloud stocks are valued very highly, often on those consumption-based models, which are currently suffering from some broad macro softness, some belt tightening.
So the hypothesis is
that IBM's floor, which is built on that strong Z system demand, the $9.5 billion AI book of business, and that high FCF generation will hold firm, while the temporary Red Hat deceleration corrects itself in 2026, just as management predicts. So you're essentially buying defensive AI infrastructure and selling purely cyclical consumption anxiety elsewhere, hoping to capture that delta.
That really does capture the complexity of the push and pull of this quarter perfectly. Okay, so to wrap things up, IBM delivered beats across the board, substantially raised its free cash flow and revenue outlook for the year.
Check.
The strength was clearly driven by that powerful Z system cycle, robust performance in automation software, and strong AI acceleration picking up within the consulting business.
Correct. However, that after-hours stock drop highlights the market's maybe hypersensitivity to software momentum right now, specifically Red Hat's current growth cadence, despite those strong leading indicators like bookings. The core narrative for IBM remains, I think, a strong, high cash flow pivot towards a hybrid cloud and AI future. But for now, that Red Hat deceleration provides a really interesting point of friction and volatility, and perhaps opportunity for careful study.
Absolutely. We hope this deep exploration of the IBM Q3 call gives you a clearer edge in understanding this quarter's complex story. And just remember, the contents of this conversation are purely for informational and entertainment purposes only. They are absolutely not financial advice.
Please consult a professional.
Thank you for joining us.